Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Hello, everybody, and welcome back to another episode of Living Your Greatness. This is your host, Ben Mummy, and on the line today is a new guest to the show, and his name is Chris Temple. For those of you that don't know Chris Temple is an editor and publisher of the National Investor. He has an over 40-year career now in the financial investment industry. Chris is a highly respected guest on radio stations, podcasts, blogs, and many other media platforms across North America. His ability to help average investors unravel, understand, and navigate today's market is incredible. And his ability to uncover off-the-radar companies is remarkable. His commentaries and some of his recommendations have appeared on Barron's, Forbes, Wall Street's Best Investments, the Cabot Group, Kitco.com, and many more. Welcome to the show today. It is great to have you on.
Well, thank you, Ben. It's great to be with you, and congratulations on your enterprise and all the great work you're doing.
Thank you so much, Chris. So, Chris, let's kind of get rolling here. If we start with your background, where are you from in the United States? Can you tell us more about your formative years?
Well, sure. I grew up, Ben, in upstate New York, a city called Binghamton, which is famous for Endicott Johnson shoes, one of the great corporations in U.S. history that treated its employees better than any company treats them today. Also not far from the home of IBM. And last but not least, famous for a hockey team called the Broom Dusters that were a part of the old North American Hockey League that the cult classic Slapshot was based on. I actually got to be on the ice as a teenager with some of the guys that you'll see in Slapshot. So that was a kick and then some, I can tell you.
How did you discover the precious metals and the natural resources?
Well, that's a multi-part answer, but I'll try and condense it, Ben. First of all, when I was going to high school, the idea that I had most of the time was I was going to become an accountant. One of my best friends, his father was the head of the accounting department at IBM, and I pretty much had an open door if that's where I wanted to end up. But right after I graduated from high school, I was talked by a friend of mine whose father was one of the two partners in a financial planning firm that, hey, Chris, you like math, you like numbers, you like economics, you've got an aptitude for that. Why don't you look at the investment financial planning business? So long story short, I got my insurance licenses just months after I graduated from high school in 1979. I quickly got my securities licenses after that. By the time I was 20, I was a general securities principal with the firm I was with. But what was happening uniquely at that time was that we had, in the late 70s, and as we were going into the early 1980s, runaway inflation, worse than anything that anybody had ever seen up to that point in the U.S. that was alive then. We had interest rates that were starting to creep up, and we had a monstrous bull market for commodities. So, look, as a financial planner, or whatever you want to call yourselves, what you are basically is a glorified salesperson, and that's true today as well. The average financial professional does what their bosses tell them to do. They follow different formulas and whatnot. Now, our abilities were much less constrained back then as brokers. We were able to look at a lot of different things. You don't have all of the regimentation that you do today when it comes to typical brokerage firms. And one of the mutual funds that we were putting our clients into back then to capitalize on the dropping dollar, the higher inflation, and the run in resources was a fund that had been, up until about 1978 or so, the average run-of-the-mill diversified stock fund but they wisely loaded up on gold and energy-related stocks. So I think it was in 1979, their return was 32% for the year. In 1980, it was just over 60%. And those kinds of returns were unheard of in those days for the average stock mutual fund, and we were looking pretty smart, And so that was my first interest, or my first introduction. And I didn't even understand all of the dynamics behind it at the time necessarily, Ben. All I knew is that gold and oil and stuff was the place to be in the late 70s and as we went into the early 1980s. But after that, I can tell you that a very hard lesson, and really my baptism by fire in this industry, was when all of a sudden those same things that were going up rather dramatically started to turn around and go down. And the helpless feeling that I had back then was I didn't know why. I would ask, the guys that ran our firm. I would ask the wholesaler for the mutual fund. I didn't have any idea why these things weren't going up anymore and were going down. And looking back, of course, we know that Paul Volcker, who was the Fed chairman in those days, did 180 basically with Fed policy, his first of two that he did. But the first one jacked interest rates way up to wring out that inflation, to shore up the dollar. He did that at the expense of a nasty recession, which we had as a result. And as well, we saw gold, which peaked at well over $800 an ounce, come crashing right back down, as did oil and as did a lot of other things. So, when we look back, anybody that claimed to have any expertise in the market should have understood what the consequences were going to be. I didn't. And I promised myself that never again was I going to be caught with my pants down. I was going to get to the bottom of this, understand how the Fed operates, understand how our fractional reserve system operates, understand how what the Fed does impacts markets and so forth, and never be caught in that position again. And knock on wood, I haven't been for the most part. So, that got me interested in gold as an investment, and also in those same years, I was learning more and more about our history as a country, particularly our monetary history. And so as a gold bug, philosophically to some extent, I was taking a keen interest in precious metals almost at the same time.
So Chris, just going to my next question here, you are known as the National Investor. Can you please explain why you go by this name?
Well, sure. After I went through that episode I just described, Ben, I always had a talent for writing and speaking and being able to articulate things. That's my love. I love to educate people. On my website, my motto says you can get information anywhere, but here you get knowledge. So I always had an affinity for trying to explain things to people. And even with this firm that I started with, we had a little thing that was kind of a newsletter that we did for our financial planning and estate planning clients called the Money Minders Club. And I would write some of the articles and compile some of the content for that. A few years later, when I left that firm and was still working in the financial planning industry, but more independent than I had been, I wanted to do the same thing for my clients. And so I came up with a newsletter that was called Your Money Today. By the time I got into the mid-90s, 1996 specifically, I was looking to really set myself apart as a writer and commentator with my newsletter. And one of the themes that I wanted to stress was, and it's become more fashionable since, kind of an America First theme, if you will. Most of my adult life, or pretty much all of it really, had been looking the world over for investment ideas. And of course, you can go to the typical financial planner or broker and you might be invested in European stocks or Asian stocks or China or whatnot. And as an American, I didn't like the idea that, and nothing against those countries or the people there, but I didn't like the idea that as a country, the U.S. had surrendered so much of our manufacturing ability and intellect and sovereignty to other countries just for the almighty dollar. And so one of the reasons why when I turned what was more a serious hobby called Your Money Today into more of a serious standalone newsletter, The National Investor, one of the themes I stressed was that I wanted to focus, not 100%, I still have, of course, especially in a resource area, companies that are based in Canada or some of them in South America when it comes to resources, a handful of them. But by and large, especially when we're talking about companies and industries other than natural resources, I wanted to focus almost entirely, a couple exceptions here and there, but almost entirely on U.S. companies that have an edge where it comes to biotech research, where it comes to making different things better, et cetera. One of my more recent additions to my recommended list is one of the coolest stories I've ever seen in agriculture and the remediation of pollution that comes from agriculture. And they're a company based here in the U.S. So that's the MO for the name, The National Investor.
Okay, great. Thanks for giving us that background story of your name. I kind of want to go to some recent news that we heard earlier this month. Ray Dalio, who everyone knows as the founder and the co-chairman of Bridgewater Associates, raised inflation concerns over federal spending at the Wall Street Journal's Future of Everything Festival. Ray Dalio had actually said there are two types of bubbles. There is the debt bubble and there is the debt time comes back and you can't pay for it. And then you have the bubble bursting. And the other kind of bubble is the one where there's so much money and they don't tighten it as much, so you lose the value of money. Hearing this statement, what is your opinion?
Well, one of the things that I've talked and written a lot about, there's a number of items on my website, nationalinvestor.com, that people can read that's out there for public consumption. You know, we have what I call the deflation debate. And some people are saying that we're seeing for the first time in several years headline inflation that is running hotter than it has maybe in 10 years or so. And on the surface, that is true. But a lot of things have changed since my baptism, if you will, in this industry back in the late 1970s. Inflation is not the same in the year 2021 as it was back then, largely because monetary policy is not the same as it was back then. The biggest difference being that in the 1970s, then it was uniquely the United States of America that was cheapening the dollar with the world's reserve currency, so much so that the former French general and then later President Charles de Gaulle was at least indirectly responsible for global run on the dollar. They were all coming to the Fed window, which in those days, even though you as you're not an American, you're Canadian, but I as an American, if I wanted to, I could not take my Federal Reserve notes to the Fed or the Treasury, either one, and redeem them for gold, but foreign holders of U.S. debt could. And a lot of them, led by de Gaulle, were seeing the U.S. debauching its currency at a time when the rest of the world was running, at least in relative terms, certainly sound money. And that was what caused Nixon to finally say, hey, we don't have the gold to back all this. He closed the gold window, took us off the, quote, gold standard, and he unleashed Arthur Burns, the Fed chairman that he chose on the world, and we had what we did in the 1970s. The difference between then and today is that the entire world is doing the same thing. In a lot of instances, worse than the U.S. I mean, up in Canada, you've got a worse debt to GDP ratio than we do in the U.S. The debt in relation, the annual deficits rather in relation, and I think the debt also in Canada relative to the size of Canada's economy is worse than the U.S. China is far worse than anybody in the world when it comes to their debt to GDP ratio. Europe's banking system is a shambles. Most of all, in relation to Dalio's comment, look at Japan, where their financial bubbles peaked. The stock market peaked in 1989. Japanese real estate peaked a few years later. Neither of them have since then, in 30 years, reached the levels they were at their peaks. Yet Japan has continued to keep interest rates sub-zero most of the time. They've continued to paper over all of their debt. But can we really say that in Japan debt is a bubble when it's self-funding? So the whole world is guilty of all of these sins. That's the way, unfortunately, that fractional reserve banking is. Will it go on forever? No. But I think that it's a much deeper discussion, and we probably have time for today, to be able to understand in the year 2021 how we judge bubbles, how we judge these different kind of things. A lot of things that were supposed to happen in the U.S., for example, and I just did a meeting on my way up here to northern Wisconsin with some subscribers and friends in the Chicago area last Friday night, explaining that 40 years ago, when I started in this industry, and the U.S. debt was approaching its first $1 trillion level. Now we're nearing $30 trillion, and yet inflation and interest rates, instead of going up from those levels, have gone down. At various times, you have people fighting over putting money in treasuries at almost a guaranteed loss. Nobody would have predicted 40 years ago that we could have reached this level of debt and still had the stock market at 34,000 or some odd level on the Dow, et cetera. So, we could very easily see in the next 20 years, these bubbles all continue, things will plod along. 20 years from now, the Dow might be 100,000. The problem for the average person, however, will be if the Dow at 100,000 will not buy you in goods and services what the Dow at 34,000 will today, any more than the Dow at 34,000 today means that the average American person has got a better living standard than they did when the Dow was 1,000, more or less, when I first got in this industry. So, the financialization of everything has given us a veneer of prosperity when in actuality it's very few people, relatively speaking, that participate in that.
Last August, gold reached an all-time high of $20.89 per ounce. It appears that gold has finished consolidating and is now on an upward trend. Do you believe this is true? If so, what fundamentals and technicals are in place to support your reasoning?
Well, I'm sometimes a guy that the more religious gold bugs love to hate, because I actually use a forbidden four-letter word from time to time, Ben, which is spelled SELL. When gold hit $20.89 an ounce last summer, I told people to sell all of our trading positions in precious metals and even a couple of individual stocks that I didn't want to write down when we had this correction that we did since then. And importantly, and this is very key for people to understand, gold continued to go down until just a few weeks or so ago when it started to gain some momentum, despite Joe Biden being elected the U.S. president, despite the Democrat Party winning a narrow, basically 50-50 split with Vice President Harris being the tiebreaker in the Senate, and despite Janet Yellen, the former Fed chair, being appointed Treasury Secretary. Now, if you listen to the average gold bug, all of those things, we should be at 5,000 an ounce already for gold, but we weren't. And the reason for that, and I have, it was updated last summer. I'm about to update it again, a special issue that people can also read on my website entitled "This Is Not Your Father's Gold Market." We need to realize that what is going to drive the gold price and ultimately following that gold stocks has nothing to do with what gold bugs believe, because gold bugs are barely a rounding error as a percentage of the overall number of people out there that have money to invest. And all the rest of those people, Ben, who have money to invest, do not get up every morning eating, drinking, sleeping, and thinking about gold. They're looking for what the best story is. So that said, you need to understand what factors need to be in place, not for gold bugs to think gold's going to go up. They're 100% invested 100% of the time, by and large. And that's an oversimplification, but to make a point, what matters is what is going to cause Wall Street to say, gee, maybe we need some gold. Maybe we need to get back into gold again, at least as a trade. We see this from the Fed. We see this from other asset classes. And there's a lot more people can read on my site about this, but basically two things have changed recently that has allowed gold find its recovery and break a couple of important downtrends just in recent days. Number one is that this big spike we had earlier this year, higher in long-term interest rates for the time being, has dissipated. There's a lot of reasons for that. I think if you boil it all down, enough people in the markets are still mesmerized by the Fed's Kool-Aid, if you will, and the Fed's efforts, I must also add, to keep interest rates tame, that has taken some of the pressure off of gold, because for a long time now, gold and treasuries have been joined at the hip. If long-term interest rates start to rise again, I promise you it will keep gold in check. So the fact that we raced up to about 1.75% some weeks back on a 10-year treasury, and it has since come down, even when we've had these hotter inflation numbers lately, that has benefited gold. And the other thing that has benefited gold is that the generalist investors have looked around them and they've seen the bloom start to come off of the cryptocurrencies, and they've seen what appears to be a topping in the overall stock market. So don't forget that when it comes to the 99-point-some-odd% of investors who are not gold bucks, they don't have a philosophy against gold as much as they have a philosophy for making money. And when in recent months there has been great action in lithium, uranium stocks, biotech stocks, the FANG stocks, cryptocurrencies, and just about everything else, a generalist investor is not going to be in gold. And I guarantee you a money manager is not going to go into gold thinking that he wants to get ahead of the crowd, because if he starts to put money into gold, which is weak, and he's ignoring all these other things, he won't be managing money much longer. He'll be driving an Uber or delivering pizzas next week. So you have to ask yourself, what is going to cause these other people to get in? And I believe that we've seen glimmers of, and I wouldn't be, I wouldn't be flashing the green light yet, because I think that notwithstanding gold's breakout recently, it's not going to be a big surge higher anytime soon. I think that the low, however, is in. I don't see us going back and revisiting those. But when it's really going to matter, Ben, is when we get to a place with the overall economy when people realize that the sugar high that we've been on from all the stimulus and all the Fed and other central banks putting more gazillions of dollars into the system is not going to get us much more traction when it comes to legitimate economic growth. And when we have continued and if not increased money printing as the economy starts to bog down again, that is when gold will rise to the top instead of lagging everything as it did since last summer.
You know, Chris, you had spoken about Bitcoin. There's been a lot of excitement, especially with Bitcoin, hitting, over 60K. But now all of a sudden, in the last week, right, its price essentially tumbled back to 50%. Mark Cuban, an American billionaire, calls the crypto crash the Great Unwind. Do you agree with this statement?
Well, I do. First, I have to confess that I have never advocated Bitcoin. I've never bought any. I've never advocated buying it. I wish I had Doc Brown's tricked out DeLorean to go back in time and buy a truckload of it when it was just getting started, but I didn't. So that's water under the bridge. To me, and philosophically, as I said earlier, I'm more of a gold bug than gold bugs are. I think that the Federal Reserve has been a horrid entity and institution in American life. It has tainted a lot of what's going on with the world, as has the U.S. dollar. That's an entirely different discussion that maybe down the road we can talk about. So I am in favor of anything that can be used as money by the average person, that is honest, that is interest-free, and that is not controlled by a central authority. I've been an advocate publicly for many years for time banks, for community currencies, for barter systems, everything. But Bitcoin, to me, has been a speculation more than anything. It's the greater fool theory on steroids. It has utterly no utility for the average person, and it is not a store of value. It is a speculation. And I know that rankles some people who were smarter than I was and actually bought some of these tokens and made a lot of money. I wasn't one of them. But, I would also be seen as an oddball if I was at some lord's estate in Amsterdam in about 1632 or 33, and I confessed that I had not hocked my family estate to go in all in on buying tulip bulbs. It wasn't fashionable in 1999 if you went to a cocktail party and said that I think the tech stocks are a bubble and I don't want to take part of it because I don't know when the music's going to stop. And likewise with these cryptocurrencies, and we're finally seeing some of the soft underbelly revealed over things like money laundering that the regulators will use as an excuse to start cracking down. We're seeing talk specifically about Bitcoin with the obscene amounts of energy used for this play toy of traders. So, look, I think it's really a darn shame that something that is a promising technology and could be the basis of a truly free currency and medium of exchange of the future has been so relegated to be just a Twitter-based fad and a speculative vehicle for people that I think the average person just doesn't understand, that especially with this particular kind of an asset class, when the music stops, there are not going to be that many shares. And you've seen just how fast in the matter of a few days. And this astonished me, Ben, when I saw this statistic. From the recent peak for these cryptos down to the trading low, and some have bounced since then, $1 trillion was obliterated. $1 trillion globally. How do you even get your head around that? Is anything that's real when you can say that $1 trillion just vanished into the ionosphere? It's crazy. So, I want to believe that some of the technology behind these cryptocurrencies is going to be with us for a long time. It probably will. The central banks, of course, will try and co-opt it to keep us all into their managed fiat currencies. They're all making noise about that. The Fed, the ECB, China, just about everybody. But in their present forms, I still am not an advocate of any of these cryptocurrencies.
This actually brings me to my next question. Goldman Sachs, a leading global investing, banking, securities, and investment management firm, has recently described Bitcoin officially as a new investable asset class. Chris, do you believe this is true? And also, do you consider Bitcoin or any other cryptocurrency an investment asset? What do you think this investment option will have or kind of serve people?
I don't think it serves people well, and I don't believe that you can classify it as an asset class compared, generally speaking, at least to stocks, to bonds, to real estate, to precious metals, to commodities. I from time to time have had my own subscribers ask me, well, how come you're not getting on the cryptocurrency bandwagon? And my answer simply is that I have got so many stories. Some I've already recommended my newsletter, and I'm not pretending I get all of them right, Ben. I have losers as well as winners, but thankfully the losers are in a minority and the winners are in the majority. I've got so many companies that I can't keep track of them all that have got real assets, real technology, real people. Some of their products and services will genuinely enhance people's life, their health, whatever. That could be 10 baggers, 20 baggers, 50 baggers, and I can get my head around them. They're real. Why do I want to bother with what Goldman Sachs, and I disagree with them on this, this quote, investable asset class of cryptocurrencies, which to me, one of the things you must have with a legitimate investable asset is a liquid, reliable two-way market. And you don't have that with cryptocurrencies, certainly not to the extent of most other assets, in my view. It doesn't take that many people to hit the sell button to cause these values that are, again, they're out there in the ether. There's nothing tangible about them. they'll evaporate. One of the most comical but real examples I saw of this, and this is going back some time, probably a couple of years or so ago. I watch CNBC regularly during the day, not because I agree with everything and every person on there, but because it's a habit, because I can see the prices go across the ticker, and I can listen to some people whose opinions I do value. And you got a guy on there, Brian Kelly, who is one of the regular commentators, and he's been kind of the Bitcoin guru at CNBC. And he decided one day on their program, after the markets had closed, to try and demystify this whole subject for people and to show how Bitcoin works. That, hey, you can buy and sell Bitcoin just like anything else. So he, I guess in a way, was trying to show how it was just a garden variety investable asset class like everything else. So on live TV, the camera on him and his computer screen, he goes to his own Bitcoin account and he puts in an order to sell 1/10 of a Bitcoin that he had in his account. An error message came up. So he tried again to put in an order to sell 1/10 of a Bitcoin. Here again, an error message came up. And probably realizing his mistake, he changed it to buy 1/10 of a Bitcoin, and it went through. And to me, that was a microcosm of the entire story of these things. It's like when I was a kid growing up in upstate New York, I used to love to go down to the Shenango River, the Susquehanna River, with my minnow trap. The point is that when you have the bait inside these traps, it's easy for a minnow or a crayfish or whatnot to get in, but then they can't find their way back out. And that's the way markets can be generally, but it's especially the way these cryptocurrencies are. There are not a lot of chairs when the music stops, and we just saw it again, and we'll probably see it again in the future. So, again, a store of value and a legitimate alternative currency is something that is way more reliable and liquid than what these cryptocurrencies are.
So, Chris, it is evident that the U.S. dollar is falling. What do you think are the top 3 assets that someone should invest in to protect their wealth?
Well, I'll tell you, the Fed, and I did a podcast with, I'm sure you know, our mutual friend Trevor Hall recently with Mining Stock Daily, and we're talking specifically about the Fed. The Fed is doing way more right now than it lets on, both in buying treasuries and in trying to intervene in currency markets to keep the dollar weak. They are in full-on inflate or die mode, and that, of course, is the famous phrase from the late dean of newsletter writers, Richard Russell, who started, among other things, in the Dow Theory letters many, many years ago. But they have no choice but to push the dollar down. The risk, of course, is that if something breaks, because we've had so much hyperinflation in the markets in the recent past, that there is a risk that something gets top-heavy and some fat-fingered trader zigs when he should zag or something, and we have a repeat, at least in pattern, if not in degree, of 2008, and things tumble and the dollar spikes back up. So you still need to look over your shoulder for that. But that said, the Fed, if it has its way, will keep the U.S. dollar weak. They'll keep real interest rates going down. And that means that longer term, even if it's still not, time to pound the table bullish yet, that gold will lead as the U.S. dollar and real interest rates continue to weaken. That's number one. Real estate is a multifaceted story. I like farmland, especially where it hasn't been bid up already, and I like a lot of residential land that hasn't been bid up already. I live in St. Augustine, Florida, and there's a building boom going on there like nothing anybody has ever seen. You go downstate and you have realtors who are literally knocking on a door of homes worth a couple $1 million, begging them to sell because they've got people lined up. So you've got a frenzy of people buying real estate in different areas. Of course, a lot of that has to do with politics and people leaving blue states and wanting to move to Florida, which is a, quote, red state, Republican and much more in favor of individual liberty than states like New York and Illinois and so forth. But believe it or not, for all of the fighting over property on the coasts and the beaches and, the desired places out in the Rocky Mountains. You get some of the suburbs, the ski areas outside of Denver where real estate is in nosebleed territory. There's a whole lot of good real estate in rural areas in this country that's still dirt cheap. Even you can go inland 30 or 40 miles from the beaches in Florida, and you would be shocked at how inexpensive stuff is. So I like real estate, both residential and some farmland. So that's another, I think, inflation hedge. And last but not least, I think that you need to look at the broad landscape of markets. And I had a subscriber ask me this recently who has one of those ridiculously now overpriced pieces of property out in one of the ritzy areas of Colorado. He's tripled his money, I think, on this place in just the last few years. And he's trying to figure out what to do. And I said, even though there's a risk near term of a blow off in the markets, we'll see everything that has rallied, give some of that back, and perhaps sooner rather than later. Long term, the Fed will continue to keep printing money. If they have to, they'll add another zero to the next quantitative easing program. So that's not going to surprise anybody, or shouldn't surprise anybody. So ask yourself as an investor, what is there out there that has not had a big run in the recent past, like the tech stocks, like the cryptocurrencies and whatnot? Most of these things are in commodities. Some of them have come up a lot already, but I think that there are some commodities out there and some stocks that benefit from them that have not yet had the kind of both fundamental, based on their individual stories, as well as Fed money printing induced runs. And so, when I talk about things like that, the one at the top of my list is uranium. There's a bull market building for uranium and nuclear energy, unlike anything we've seen. It's going to be the hottest thing in the next couple of years.
So, Chris, what commodities do you think will perform best in 2021?
Well, look, I think uranium, as I said, is going to be at the top of my list. Lithium will do well, some of the other base metals. Here's what you've got to understand, though. Generally speaking, commodities in relation to financial assets have had a lot of catching up to do. Perhaps some of the people that are listening to our discussion, Ben, have seen the charts going back decades that compare the level of financial assets to the level of commodities. And until recently, when we've seen things like copper and iron ore, and there's been a nice recovery in lithium, nickel, and others have pretty sharp rallies, they were very, very much lagging financial assets. And they've closed a lot of that gap recently. And long term, I think that they will continue to do that. I do have to push back a little bit, however, on some of the notions that are out there that we're going to have this open-ended, multi-year secular boom in commodities. Copper, because of its use in the green economy and electric vehicles and stuff like that. Copper, which recently touched its 2011 high of nearly $5 U.S. a pound. It's fluttered back down a little bit. You've got predictions of $10 to $20 a pound for copper, which one day we'll see simply, for no other reason than the Fed is going to keep printing money and everything will be more expensive in dollar terms. I'm not saying that's not going to happen. But beyond that, this is another way in which the present day is different than when I got in this industry and started looking at these things in the late 1970s. And back then, when you had a multi-year cycle of cost push inflation, as we called it back then, you would have prices rise. You would have U.S. workers able to get much higher wages, whether negotiating with the union or whatnot. And then that would enable them to pay the higher prices for goods and services. That would encourage companies to raise those prices further, and so forth, until Paul Volcker brought all of that to an end as we got into 1981 and 82. Today, the average household and pretty much the average business in this country, and really I think this is true in the world, has maybe a fraction of the ability to absorb or pass on those costs. Here in the U.S. especially, a lot of people feel in Fat City because they're getting these stimulus checks and they're getting paid to stay home and not go out and work, so they can stay home and trade doggy coins online, or they can, go on to Reddit or Robinhood and learn about stocks where they don't care a bit about what the company is. They just follow somebody's advice and think that they're going to get rich by trading stuff they don't even know or understand or research. So that's going to go away one of these days. And we're going to be back at a place where the economy is kind of lurching along again. But now in 2021, after all the Fed money printing, after all the stimulus, after all the other borrowed money, now we're that many more trillions of dollars in debt that need to be serviced, and it's going to be harder to do that. So, it's a very interesting study right now, Ben, and you really have to do it on a commodity by commodity basis and ask yourself, okay, uranium is a no-brainer because that's a needed raw material for utilities that are fired with nuclear power, with uranium. It's something that the whole world is moving back toward because it's the best way to reduce carbon emissions, since the nuclear power plants have no carbon emissions. They're really the best large-scale source of green energy that you can think of, and far more reliable than wind and solar. So uranium is a no-brainer. Copper, okay. I understand that with the green push the world over, that there's going to be a lot more copper used. But at what point does that take the cost of an electric vehicle, which uses 3 or 4 times more copper than a car with a traditional internal combustion engine? When does that make the cost prohibitive again? If it does so, is there going to be the political push to have such large subsidies for these electric vehicles to help people buy them? So, we have this dichotomy in a way of an irresistible force, this move toward a green economy, which I'm wholeheartedly behind, by the way, in a variety of ways, that's going to require far more copper as well as some other metals to be mined than what the world is doing right now. So, and all of those are in shortages, either now or they're going to be for years to come. There needs to be way more production globally of a lot of these things, including copper. So you've got that irresistible force, but the immovable object is the ability of people to bear those higher costs. And if they can't bear it, what gives? So it's gonna be a lot more complicated story going forward, I think, than people realize. And so, pardon the rambling answer somewhat, but as far as commodities, of all of the raw materials, uranium is number one on my list for a variety of reasons. And actually, people will be seeing my uranium-related issue here imminently as well, finally. And as I said earlier, I think if you can selectively buy some residential real estate and some agricultural-related real estate in areas where they've not already been picked over, that's another area that I like as far as commodities, raw materials.
All right, great. Thanks, Chris. For the benefit of a millennial investor listening, can you recommend how they should allocate $20,000 across the precious metals and natural resources space? So, for example, ETFs, metals, miners, mid-tiers, and juniors?
Wow. Let's see how I can best answer that. First of all, one of my favorite sayings is that perhaps in heaven, as we read in Scripture, the streets are paved with gold, but here on earth we use asphalt. So as I answer this question, I don't want anybody to get the idea that people should have all of their money in gold in any way, shape, or form. It should be a part of your portfolio. My MO is that I have about a 15% overall portfolio allocation right now to the precious metals area, but exclusively via companies that I think have superior long-term stories and that I'm willing to ride through the ups and downs. So of that $20,000, if that was all I was going to have allocated to the gold space, I would have maybe 10 or 12 of it right now in a mixture of individual companies, mostly mid-tiers and junior exploration companies. I would not have any in any of the majors. If I get to a point, again, where I think that gold has all of the stars aligned and it's going to run for a while, I would take the rest of that money and buy the major ETFs and the leveraged gold ETF as a trade. Those are the kind of things last summer when gold peaked at over 2,000 an ounce. I told people to sell. We kept almost all of our individual stocks because I like their stories long term, and I don't want to be cute trying to pick an exact bottom and have a company come out with great drilling news and it goes up and I'm out of it. So I have kind of a two-part system if I'm making myself understandable. One is your core position in mostly exploration stocks that have got the better management, better stories, superior to their peers. But then when the sector overall looks better, and again, this is the key part, Ben, when you see generalist investors in Wall Street warming back up to gold, then you take more money and you put it into the places that they're going to go. Because when a big brokerage firm puts out a buy recommendation on gold, it's not going to be in some small exploration company with a small market cap. It's going to be in the GLD ETF. I prefer one called UGL, which is the leveraged gold bullion-oriented one that will give you more bang for your buck as gold goes up. Or you get into the major ETFs, GDX and GDXJ, which respectively are a basket of the major producers, and then secondly some mid-tier, mostly producers. Some exploration companies at GDXJ too, but it's kind of a mix.
So Chris, what are your top stock recommendations for 2021?
Oh my gosh, I've got too many that I can get into, but I want to clarify, at least in the gold space, a little bit more of the litmus test, and I will mention two of my most recent recommendations. When you're looking, especially at exploration, so that's where you have the potential, of course, for the most substantial profits if you pick the right company. You have a major discovery of some kind, and the biggest surge in a share price always comes on news of some kind, where a company that's drilling and exploring a certain project, they have some success, they uncover what could be a mineable deposit, and you see stocks go up 10, 20, 50 times in some cases if you pick the right stock. The disadvantage today for the average person is that even though when we go back to 2011, another time with the beginning of the year when I told people to cut back substantially on my recommendations because I believe gold was peaking back then and silver. You go back to that time, and for several years after the peak in 2011, we had a nasty bear market for years, and a lot of the more religious gold bugs out there that hate that four-letter word sell, they wrote everything back down to, and I know some friends that did this. I mean, the dollar in 2011 became 10 cents by the time we got to 2016, and now maybe they're back to 40 or 50 cents recently. That's not the right way to do things. But one of the unfortunate things is that, in my opinion, we didn't see nearly enough gold companies just go out of existence with that bear market. So there's still, in my view, way too many companies out there that, they put on a good song and dance and have fancy corporate presentations. And if you go to the gold investor conferences, they put on a nice meal or have a nice glitzy booth or something like that. But they're at best medium companies. And so what you want to look for is a company not that has maybe 1 million ounces of resources now, let's say, of gold, and they've got a game plan to do this, and here's their drilling strategy and the rest of it, and maybe they can turn that 1 million ounces into 1.4 million ounces or something like that. There's so many companies out there that can make a legitimate claim maybe to being able to do that. You can't keep track of them all or possibly invest in but a handful of those. What I want to look at, and again, I'm not pretending I get them all right, because I don't. But what I'm looking at is who's got 1 million ounces of resources now, but has got a fresh perspective on their project and has thought of something else, or their geologists have thought of something else that the last operators of this project didn't have. And they're not going to turn that million ounces into 1.4, 1.5, but they've got a legitimate case to make that they could multiply that by several times. So go from a 1 million ounce resource to maybe 3 million or 4 million or 5 million ounces. Those are the companies I'm looking at. And or who's got kind of the market cornered on an area that could be an entire district that is very underexplored, but it's got a good game plan for that. So on the first of those themes, at the beginning of the year, I recommended a company called Gachal Gold, which has got an exploration. They actually got a few exploration projects, but the big one is called Fondaway Canyon down in Nevada. And they do have a legitimate case to make where they can take an existing resource, a little over 1 million ounces of gold, and multiply it a few times. And I won't take the time to go into all of the geology there in the case, but when I first looked at this company some months back, the light bulb went off over my head, and I said, okay, this is not your normal garden variety exploration story like everybody else is out there. These guys have got something different than the crowd does. And so I recommended that to my subscribers back in January. And another one that meets the latter thing that I discussed of, an underexplored potential district play, where in this case they're turning virtually no resources perhaps into something eye-catching, is a company called Quebec Precious Metals that is exploring up in the James Bay area of Quebec. So when I'm looking at exploration plays, those are the kind of things I like. As far as producers, half by accident, I ended up with Yamana Gold on my list of recommendations recently. Their finances have been stellar. In fact, one of the things that the whole industry has managed to do in recent years is go from where gold companies were a pariah among generalist investors for paying executives too high a salary, rewarding everybody except shareholders, to now a lot of them, you got the producers out there that really cleaned up their act. They've cleaned up their finances. They've gotten rid of a lot of debt in a strong market of the last couple of years or so. And you've got some really good companies out there whose valuations are better than most anything else on Wall Street, Yamana being one of them. And we ended up with Yamana on my recommended list again recently because they bought out two of the main assets of a company called Monarch Gold that is Abitibi-focused company up there, which is also one of my recommendations.
Okay, great. So, Chris, where can my listeners go to connect with you online?
Well, my website is nationalinvestor.com. And if you go there, as I referred to this a couple of times during our conversation, Ben, I've got a number of recent commentaries on the overall markets and some individual companies that I've profiled. And you're going to see a deluge of things just in the coming few weeks as far as special issues, including one on the gold space. So all you have to do is go there, and there's a spot where you can sign up to be on my mailing list. It doesn't cost you anything, and you'll get all of my public commentaries and things like that. And if you like what you see, you can also become a paid subscriber, where instead of getting an occasional recommendation here and there, you get all of my recommendations on how to manage your portfolio. So that's my website, nationalinvestor.com. Just drop me a line at chris@nationalinvestor.com. If you want to just send me an email, tell me you'd like to be on my list. And of all the different social media presences I have, I don't use enough of them enough because I guess I'm too old school and old fashioned, when it comes to some of that stuff. But I'm getting better. But I'm more active these days on Twitter, and if you want to follow me on Twitter, where I'm most active, it's of course, the @ Nat Investor, N-A-T Investor.
Okay, great. That's awesome, Chris. So I will make sure to put that in the podcast notes. And I just want to say again, Chris, it's been a pleasure having you on the show today, and I cannot wait to have you on again.
I'd be delighted anytime. Just let me know, Ben. You're doing a good job, and I'm happy. Not that I'm going to date myself any more than I already have in this thing, but I'm glad to see when some fresh new personalities are coming up that are approaching the gold space especially, but investing generally in a way that's constructive. And so, again, congratulations on the job you're doing.
Thank you for listening to the Living Your Greatness podcast. If this show has added value, Please subscribe, leave a rating, and make a review. This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.